Dr. Banerji, let's start by understanding the European situation as is. Do you believe that there is some sort of a consensus internally among EU leaders on how to avert a complete breakup of the European Union? Because that's the biggest fear in the minds of the market.
I don't think there's a proper consensus between the European leaders. But the position that they have now, the one that they're projecting, is led by Germany and France. And it has a combination, it's a long-term view that austerity should be brought in to stabilize the fiscal deficits, and simultaneously a support program through the European Financial Facility that we've mentioned, or the ESM, should come in to stabilize. Now, there are a number of actors who are not convinced by this. Well, I have to say I'm not convinced by it, but we've had the Italian Premier question it, and I think Mario Monti is right in his views. And at the margins, whether they be the Irish quietly or the Spanish, a number of people are more concerned about the lack of growth at the heart of the strategy. What they have is a long-term solution for an acute problem, and they are not handling it. But I do believe that the ECB is. The European Central Bank's recent long-term repo operations, what these do essentially is allow banks to borrow an unlimited quantity of money for 1% for a 3-year period. Now that is the key, because if they have that money, the way that this European sovereign crisis unwinds is that it unwinds through the banking system, and if they can stabilize the banking system, then you've bought yourself breathing time for structural change.
So how do you see the next 6 months panning out? Because, you know, there's a bit of a political undertone to this crisis as well. And having been the economic advisor to the former Prime Minister in UK, you understand how discussions happen at the topmost level. Do you believe that political leaders from across the region can, put their minds together and try and bring up a solution that works for all, than just works for some of them?
I think the problem is that politicians, democratic politicians, necessarily are answerable to domestic electorates. But the problem is transnational. The problem is international. The politics is national and local. And matching that two requires an extraordinary degree of leadership, and I don't think we have it yet. However, we do have some of it in Brussels. We have some of it in the European Central Bank. We have some of it in the IMF. And the dialogue between them is going to move things forward. So now you asked me about the next 6 months. I think that there is a compact between the French and Germans not to talk about the crisis without consulting each other. They've caused a lot of damage last year by making ad hoc comments, and it's notable in the last couple of months they stopped doing that, which is a move forward. Simultaneously, we are seeing, as I mentioned, the multinational organizations like the European Central Bank, like the IMF, like the Federal Reserve, beginning to act to make sure there's sufficient liquidity. So I'm hoping that the huge risk aversion we've had in the markets will come down. That's not an economic solution. That's a palliative. It holds the ground for further deep reforms that have yet to come.
Okay, what about the US, in this sort of a market environment? Because we've seen signs of improvement out there, but there's still talk about how more money needs to be pumped in.
There's a very respectable school of thought that says that the structural deficits that we have are going to take time to work out. In the case of the US, the more important longer-term issues are entitlement programs that are not properly funded, and they are not dealt with at the moment. But the crisis that we're seeing at the moment, at the present time, has been is amenable to the policies they've taken. Whether it's the TARP program that dealt with some of the debts the banks had, the bank recapitalization program, and some degree of stimulus that they've had, including monetary stimulus. So this year, I think that the US, within the developed world, will lead in growth. Now, that's not a long-term solution. That will have to await the elections.
Oh, okay. What do you expect to happen after that?
After the elections, somebody was going to have to step up to the plate and deal with these structural deficit issues. I think the US economy itself is recovering slowly, much slower than in any other recovery we've seen. But for it to have a sustained recovery, we need the property market to function. And longer term, we need to deal with the entitlement programs. They're structural.
What could be the ramifications of an EU breakup if that does come by?
When I'm talking about France and Germany and Italy and Spain, they separate would have strong economic repercussions on Europe and the world, and growth would slow down. It would be very difficult to unwind their counterparty obligations. There would be a full-scale banking crisis, and coming out of that, domestic and international demand collapse.
Given the response that we've seen to the short-dated, and then now, of course, we're going to be looking at the long-dated securities as well, bond auctions in the European region, Do you believe that confidence is slowly coming back?
I think the market may have overshot on fear, and it's so worried about the issues that we've discussed that prices materially reflect that. And we're beginning to get a reversal of it. That does not mean, as I've said earlier, that the problem is over. It isn't over. We have some palliatives. But I think we're less worried about a break-up of the banking system at the moment and a break-up of the euro crisis. I'm worried about Greece and what will happen in the near term as well as the long term, and that's our immediate concern. But I think it is containable and manageable.
Now, European lending is about 3 times to emerging markets as compared to the US and Japan. What does that mean in terms of the impact that the situation can have on emerging markets and their future, if indeed European banks start stepping back on their lending?
There's a short and a longer term answer to that question. In the short term, it is extraordinary that European banks' combined lending to emerging markets is 3 times that of the US. In fact, the US and Japan combined, as you just said. And therefore, any deleveraging of their balance sheets causes a sell-off first in the fixed income and currency markets and secondly in the equity markets, which is what we saw from September onwards last year, in fact earlier than that, but on a scale. Now, any stability in the banking system stabilizes that. Now, you said, what if they continue? Well, clearly you would have further pressure on those markets. But the question to ask is, where did the Europeans get their deposits for this lending anyway? It's a recycling. And what we have is, since 2005, a build-up of the deposit base in Europe, as opposed to in the US, that has come from OPEC countries and other countries with a surplus for reasons that are probably transparent and political, but may not be, they may be commercial, that they've put their money into European banks. Now, what I'm saying is that the balance sheet of many developing economies and the developing world as a whole is infinitely stronger than it was at the time of the Asian financial crisis at the end of the 90s. So you have a transitory problem. It can last many months, it can continue, but at the end of the day, the flows will reverse. The flows are endogenous and they will be redistributed. So I'm not worried. Okay,
so when we're talking about reversal in fund flows, the sense is that 2012 onwards, we will see allocations to emerging markets as a percentage of overall global allocations increase from the average 12 to 13% there is right now. Do you see that happening, and how much increase in allocations would we see?
I do. I was very bearish for part of last year, and I was worried about this deleveraging. I think if the fear trade comes down, in other words, European banks cease deleveraging, then there will be an allocation. I've just come back from the United States, and I've been talking to institutions who have a lot of cash, as they do in Europe. They need to deploy the cash. They're overweight bonds, as they are here. They need to move into equities. And from a US perspective, if you look at the world, then European growth is disappointing and is likely to remain disappointing for some time. And the emerging markets appear very attractive. And if your weight is in those markets is half what the index indicates, then they will rebalance. And I used to run large portfolios that were asset allocation driven, and this is the time to rebalance. So actually, this does not reflect the short-term growth potential or outlook. It reflects the sheer need to rebalance portfolios and the reduction of risk. I'm positive about the outlook. I'm really positive about the outlook.
How much do you think global allocations to EMs can go up by?
I think over a year or two, I think the allocation over 3 years could double from where it is for developed markets.
From 12% it can
Oh yes,
to like 24?
It could over time. I think that it could easily go up by 5 or 6% this year or more, and then repeat itself if the growth is maintained. It's difficult to look at short-term flows, but if you're sitting on a lot of cash, if you're overweight bonds, where are you going to allocate? And institutional flows, I'm not talking about retail flows, but life insurance companies, pension funds are awash with cash, and they have to do something with it.
What about the opportunity in the EM debt market?
I think the opportunity there is considerable because interest rates in the EM debt market have peaked. The big thing that we've seen is inflation in a number of economies begin to come down. We now have evidence of easing in China. I think the interest rate cycle in India has peaked. We have interest rates coming down in Indonesia. We have it cut in Brazil. What we're seeing is a global pattern, whereas inflation has peaked, the monetary tightening cycle is over, and that makes EM debt attractive from a capital return point of view.
At a GSEC level or even for corporate debt?
I think corporate debt is a little more difficult because of the slowing economy. And there are opportunities there, but it is really analysis driven. So less for corporate debt, more for the sovereign.